Probably one of the craziest times ever to be an investor right now because there's so much crazy stuff going on in the market when it comes to AI and market valuations and Trump tariffs and inflation and interest rates and all this stuff is going on. So we're going to break down in this video exactly what I feel like is going on in the stock market and how you could capitalize on it. So this is a no fluff video, no BS, no clickbait. We're just going to go straight through what I talk about. So before we dive in, just want to do a quick update on my main trading account, $956,000. It's doing pretty good. You can see a little bit of volatility over here. It was over $1 million. Now it's down to 956. That's okay. That's totally expected for accounts right now. And especially with Trump in office right now, there's usually a lot of volatility that we're going to expect from that. So that is going to be okay. All right, so let's dive into my alpha report. So the current state of the market is what we're going to talk about right now. We're going to talk about if the market's a bubble, if it's overvalued, if it's undervalued, how could we capitalize on this, how could we make money from this. I did recently make some pretty big plays. I'm going to break that down in just a little bit, and we'll go into this account right here, and I'll show you. But let's scroll down through here. So I like to stop on the Fear Greed Index first, and then we'll go through the current state of the market because there's some really big stuff going on right now that you definitely have to know. So the Fear Greed Index, this is basically just saying, is there fear or greed in the market? And right now this needle is on 39, so it is saying that there's fear in the market. I feel like this needle is a little bit too bearish. I feel like things aren't really as bad as what it's saying. I mean, the stock market's pretty close to all-time highs right now. I feel like this is closer to 60 versus 39, which is what I said right here. And you can see right here too, I like to talk about what the rates are on the 30-year mortgage and the 10 and 2-year bonds. I want this stuff to start trending down, and you can see what I said right here, quick notes for the rates above. It's good that bond yields are falling. So yesterday we were at 4.51, now we're at 4.43. This is good because this makes stocks more attractive and bonds less attractive because we could do the comparison. If you want to get a guaranteed rate of return in a bond, and a bond is 9% and the stock market does 10% as a risky rate of return, you would assume that you would go for the bond because it's a guaranteed rate of return. It's backed by the US government. So as bond yields start to fall, they become less attractive. So that's what I want to see right there. We did get some ADP jobs data right here. You could go through and read through that if you want. But overall, I feel like the labor market remains strong. I think it's cooling a little bit, but overall, I think we're okay. The Federal Reserve is in a pretty good position right now that if the market happens to crash, the economy starts to crash, we go into a recession, interest rates are a little bit elevated right now versus recent years. So the Fed could easily just go cut interest rates and we'll be okay. That'll probably re-spark the economy quite a bit. Now, let's dive into the current state of the market. And then, like I said before, we're going to go into a couple big trades that I just made. I bought some call options. I sold some put options. I think there's definitely some opportunity out there right now. A couple stocks are beat down and maybe they don't deserve to be beat down. I'll give you my whole rundown and thesis on that in just a minute. But we have to understand this first, because if the overall market is expensive and it's going to be in a bubbling crash, it doesn't really make sense to go do other plays because the whole market will go down as a whole usually because everything is so indexed nowadays. So, current state of the market. So we're going to talk about PE ratios and valuations first. So the forward PE ratio of the S&P 500 is roughly 22, and the forward PE ratio of the NASDAQ is roughly 26. So these numbers right here are slightly elevated, but we're just going to go compare it to what historically we were at. So the green line down here on the bottom, this shows you what the S&P 500 PE ratio was on a forward-looking basis, meaning the 12 months to come, not the 12 months in the past. I'll show you the 12 months in the past in just a second, and there's a reason why we're going to do that comparison because we have to look at the past and then look forward and see what we're going to do. So 22.1 right now is where we're at up here on the top right. And I mean, when you look back here at history since 2004, it wasn't really above 20 too many times. So it was above 20 right here a little bit in 2020, but, you know, historically we're on the high end over here. So one could assume by looking at this that the market is a little bit expensive on a forward-looking basis, but it might not be that simple, and I'm going to show you why in just a second. And then if we scroll down and look at the trailing PE ratio right here, you can see we're at 30.18, and then the forward, like I said before, was 22.1. So forward earnings ratios are usually lower than trailing because earnings are expected to go up going into the future. But just looking at this chart again right here, and this chart goes all the way back to roughly 1880, so it has a lot of data built into it. You can see that we're historically high. I mean, we're above 30 right now, and it's only went above 30 like 1, 2, 3, maybe 4 times in that whole time frame right there. So by looking at these two charts right here, it's again saying we look a little bit expensive, but once again, It's not so simple. There's one big thing that changes everything that I'm leaving out of this equation right now. We're going to go into that in just a second to show you why current valuations might not be as high as what these charts look like. So I just want to give a quick little example here just so you guys understand why forward and trailing PE ratios matters so much. When you see people online talking like Tom Lee or whatever analyst is on CNBC, they talk about different types of PE ratios. So you always have to understand which one they're talking about. And sometimes they'll even do median PE ratio, not mean. Mean is the average, median is the middle. So you got to really understand what they're talking about with stuff like that. But let's do an example right here. So let's say the company XYZ is trading for $100 per share. If their earnings per share for the last 12 months is $5 per share, that's the trailing 12 months. That would mean that the PE ratio is 20 because 100 divided by 5 is 20. But what if we expect earnings to go up of company XYZ going into the future? So if we expect the earnings to go up to maybe $8 per share, now we're going to do 100 divided by 8, and that's why the forward PE ratio is going to be 12.5 and trailing is going to be 20. So this is trailing right here and this is forward right here. So forward is lower than trailing. So basically what's happening right now in the stock market is we are expecting earnings growth to go up quite a bit going into the future. If all that happens to play out, that's great for the stock market. But if it doesn't, it could be really bad for the stock market. And there's that one key piece that we have to talk about right now that really makes these charts right here actually look way different than what they actually look like right here. So let's dive into it. So by looking at these two charts right here and going through this example right here, you're still going to say, well, historically the stock market looking backwards is a little bit expensive and looking forward is a little bit expensive too. And you're totally right, but that is not enough information to make a valuation conclusion on what the stock market is as a whole. This is why. So the number one thing that matters besides earnings for companies is the interest rates. Interest rates and earnings. If you know what those two things are going to be going into the future, you will have unlimited money. That is the infinite money glitch. But that is the hard part to figure out. Earnings is one thing, but interest rates is another thing. And it all comes down to money wants to find the best risk-adjusted return. So if you could get a 10% bond or 10% expected return in the stock market, most people are going to go for the bond because the bond is a guaranteed rate of return. The stock market is volatile. It goes up and down. It bounces around like crazy. But the bond is not. The bond is just going to continue to trend up. You're going to get your 10% yield every year. And what I was talking about earlier up here, the 10-year bond is at roughly 4.4% and it's trending down a little bit right here. And the stock market is expected to do roughly 10% per year. So are you going to put your money in the stock market, get a 10% return, but it's going to be volatile? Or are you going to go put your money in a 10-year bond, collect your guaranteed 4.4%, and then you move on with your life? There's a lot of companies out there that are massively transforming the whole market. I feel like we're potentially on the cusp of a massive tech and AI revolution, but it's just getting started. So there's a lot of opportunity out there to capitalize. So maybe these numbers right here don't look so bad, but I just want to come back to interest rates because that's really massive. So looking back at 1980 right here, you can see that interest rates touched almost 20%, and they've been trending down ever since. Yes, we had this locally high area right here, and right here we're locally high too, but interest rates are expected to get cut further going through the years. Inflation is trending down, interest rates are expected to trend down, the economy is getting a little bit softer, and as the economy gets a little bit softer as inflation goes down, the Fed is then going to lower interest rates to support the economy. They want to find this balance between the labor market and the economy, and that's what they do when they adjust their interest rates right here. You can see this little dip down right here they started to cut. Now, since 1980, like I said, rates have been going down, but on a bumpy rate right there. So if we look at the chart right here of the PE ratio since 1980, so this is a more zoomed in chart, but in 1980, the PE ratio of the stock market is pretty low, because think about it. If you could go get a 20% yield in a bond rate here in 1980, or you can invest in the stock market, you can see the PE ratio of the stock market was below 10. That's why I tell everyone that interest rates are like gravity on the stock market, because rates went super high, and that's why the PE ratio of the stock market went down below 10. So just to keep things simple, if we were to go from a 30 PE ratio right here down to a 10 PE ratio right here, the stock market would fall roughly 66%. Now, we expected to go to a 20% bond yield going into the future. Highly doubtful, but this example right here just shows you the effect of interest rates on the stock market. So as long as rates continue to trend down, stock valuations can go up. So I just want to make this crystal clear. Interest rates were at the highest rate here in 1980. Interest rates started to trend down, and stock market PE ratios started to trend up. So let's look at this chart one more time. So 1980 interest rates were trending down all the way to current times right now, and that is why from here to here, valuations on the stock market continue to go up on a PE ratio basis. So yes, it's high, but the interest rates are also low, so it is within balance. And interest rates are like gravity on the stock market. I talk about it. Warren Buffett talks about it. It's very, very important to look at that stuff right there. And if you guys want, you're welcome to go read through all this right here. It's basically how money wants to find the best risk-adjusted return. And basically my breakdown right here, in a nutshell, I feel like we're in the Industrial Revolution, but for tech right now. It's kind of like the Roaring 20s for the Industrial Revolution, but I feel like we're in it for tech right now. So it could be really big. There's a lot of high expectations priced into the stock market right now. Rates are trending down, valuations are trending up. So earnings and interest rates is essentially what this whole video is about. Let's just look at history real quick, just so I could prove a point to you guys that earnings really do matter. So if you add up from 2020 to 2024, the earnings growth of the S&P 500, you're going to come out to a number that is 91% earnings growth in the last 5 years. But if you look up what the S&P 500 did from 2020 to 2024, that S&P 500 index went up 91% in the same time frame. So it's not a coincidence that earnings went up 91% and the stock market went up 91% also. Earnings do matter. Short term, it's hard to know what a stock is going to do. But in the long run, these companies are going to be put on a scale and they're going to be weighed. And when they get weighed, the true intrinsic value is going to reflect in the stock price. So did the S&P 500 go up exactly every single year according to what these percent gains were on the earnings per share? No, definitely not. But in the long run, when you average it together, you can see 91 and 91. That is what happens. So current thoughts in my head right now, be an investor, zoom out, and be patient. There's a lot of things happening in the stock market right now that are going to cause volatility, and day-to-day movements don't matter. Don't get too sucked up in your emotions. Utilize this volatility as opportunity to capitalize on what's going on in the stock market. I feel like the stock market is overall a little bit stretched right now, maybe 5 to 10% expensive. But on the other hand, Trump seems committed to keeping the economy strong and driving inflation down, which could provide stability if it actually pans out. And I've been breaking down a bunch of companies in course members only Discord where they report earnings. I listen to all the calls that give super detailed breakdowns. And honestly, most of these companies are reporting pretty darn good. So everything looks pretty good right now. I do expect volatility, like I said. Short-term stock market volatility is opportunity, not risk. You have to understand how to capitalize on that stuff. If you want to learn how to capitalize on that stuff, do my course right here at 70% off. Click the link in the video description if you want to get into that. This is just some of the economic updates that I put right there. I cover all this in Discord too. And then I have some price targets right here. You guys are welcome to scroll through this and see what I have right there. And then I just show the growth of my Charles Schwab trading account since I started it. So December of 2018, I had $0. Now it's over $950,000. And this is all off of a total contribution of $90,000. So from 90K to over 950K in just a short time frame right here, that is amazing. I've been totally crushing the stock market. So like I said, if you guys want to learn how to do all that stuff, click the link to get my course, and I'll see you guys in the next video.